everyone, and welcome to Urban Wealth Management Gig, Get in Gear Tips. We know the pandemic has really made a major impact on all of our lives, so we trust that you, your family, your colleagues, your friends are all safe and secure and stay there. But we know because we have to be sidelined and we're stuck in our homes for right now, you're probably looking for a number of ways to still stay engaged and learn about a lot of things. So we want you to know that we're here for you and we care for you. So with that said, this is a major topic that we're going to talk about today. And I'm very pleased to have one of our top colleagues and also in our network of strong professionals is Bella Wang, who is with Windes, not wine, but Windes Accounting. And she is the CPA that has been working with a number of our clients. So we're very excited about that. Just so you know, we've had 3 major tax law changes in 3 years. 2 of them have just been in the last 3 months. So we really want to make sure that you are making the best decisions, given the fact that we've had a significant change for both retirement as well as for non-working situations, businesses, employees, and unemployed. So with that said, I'm going to turn it over to Bella because she's got some really good content for you.
Thank you, Renee.
Thank you,
everyone,
Bella.
hope everyone's staying safe during this corona pandemic. And today I'm going to go over a couple of the key provisions in the CARES Act. Just like Renee mentioned, this CARES Act was signed into law on March 27 this year. And there's are a lot of changes in this CARES Act. So I want to share the key provision in the CARES Act so that can help you to plan to do some tax planning ahead of time, and then looking forward how you can adjust your retirement plan and other investments. So I'm going to start with the my first slide. I have a PowerPoint presentation here. So first, I want to talk about the stimulus check. That's the hot topic right now. Everybody is wondering if they are going to receive this stimulus check from the IRS. Some of you may already receive it. So it's also called economic impact payments. When you go to the IRS website, if you're looking for stimulus check, it's actually not called stimulus check. It's called economic impact payments.
So Bella, are you wanting to share something with us? Because we can't see your screen yet.
Yes, let me do that. I'm a very good accountant, but I'm not a IT person. So excuse me here. But I'm learning. Actually, my kids has to do the Zoom meeting with the teacher. So he's teaching me how to do a Zoom meeting now. So I have to be, stay on top of technology. So going back to this economic impact payment, it is also referred to as the 2020 recovery rebates. Because if you didn't get a payment because your income is too high now, you can get a credit on your 2020 tax returns. So first question is, how much is the payment? It's $1,200 per individual, and if you are married file joint, then you will get $2,400. And on top of that, you get $500 per qualifying child who is under 17 at end of this year, 2020. And the other requirement is that your adjustable gross income must be below the threshold. I will go over the threshold in a little bit. And also you cannot be claimed as someone else dependent, and you must have a valid social security number. So if you are a senior, you are claimed as you're a child dependent, then you won't be eligible for the payments. So how does the IRS determine your adjusted gross income? If you have not filed your 2019 return, then they will use your 2018 return to determine your adjusted gross income to see if you qualify. If you already filed your 2019 return, the IRS will use your 2019 returns. So what's the income threshold? The payment will start phasing out if your adjusted gross income is over the threshold. For married file joint, it's 150,000. For head of household, it's 112,500. For single, that's 75,000. If your adjusted gross income is above those numbers, then your payment will be reduced by 5% for every dollar that's over the threshold. So for example, let's say you are single and your adjusted gross income is 85,000, then you are 10,000 over the threshold. Then your reduction in your payment will be 10,000 times 5%, that's $500. So you will only get 1,200 minus 500, which is the $700 payments. And if your income is over, for married file joint, if your adjusted gross income is over 198,000 with no child, then you won't get any payment because your income is completely phased out. And you can add $10,000 for each qualifying child you have. For head of household filing status, is 146,500 with one child, because you must have one child in order to be qualified for the head of household status. And same as married file joint, you can add another 10,000 to your adjusted gross income for each qualified child you have. And the threshold for single filer is 99,000.
So just to be clear on this too, Bella, if your income is over, let's say your head of household, you're 120,000, or maybe it's 200,000, you still get paid for the $500 for each child? No matter what your income is?
So let's say you're a head of household. So let's say your income is 200,000, that's already over the limit. So it's completely phased out. So let's say if your adjusted gross income is 130,000, let's say. So now you are in the range between the starting phase out to the complete phase out, then you will do the 5% reduction.
Okay.
So let's say you have one child and you're head of household, so your maximum payment will be 1,200 plus 500. So your maximum payment will be 1,700. Then you will start with 1,700 and figure out how much reduction you have, and then reduce your 1,700 payment from there. So let's say you get a 1,700, your reduction is 400, then your payment should be 1,300.
Got it. Thank you.
You're welcome. And so let's say if you don't have to file the return because your income level is below the filing requirement, you are still entitled to the stimulus check. So that include like senior citizen, Social Security recipient, and railroad retiree. So since for Social Security recipient and railroad retiree, the payment was from the Social Security Administration. The IRS worked with Social Security Administration, and the IRS will send the payment directly to the recipient based on the information from the Social Security Administration. For people who don't have to file the return and also receive Social Security recipient, but if they have a qualifying child, since that information is not in the Social Security Administration database, then they will have to go to the IRS website, which is www.irs.gov, and they have to submit a non-filer information return if they want to get that extra $500 check from the IRS for the qualifying child. So let's say if you are supposed to get, let's say you are married file joint, you are supposed to get $2,400 stimulus check, but because your 2018 or 2019 income is too high, so you don't qualify, you didn't get a check. But then in 2020, because the COVID-19, you lost your job, your income is way down, and now on your 2020 tax return, your adjusted gross income is below the threshold, then you can claim that $2,400 as a tax credit on your 2020 returns. The question we have, and it hasn't been answered yet, is that let's say your income is very low in 2020, so you have no tax liability on your 2020 return, and you also get to claim that $2,400 credit that you didn't receive now. Will that $2,400 be a refundable credit? My guess is the answer should be yes, but we haven't get that guidance from the IRS yet. So for now, they are just working on sending out the payment to the all the taxpayer. The other question is, let's say if you file married file joint and you receive, each of you receive $1,200 payment now. When you file the 2020 return and you now you are separated, so would you be able to claim additional credit, or how does that work? So basically, whatever the payment you receive now will get split into half.
All right.
So next, I want to go over the changes in the retirement account. This may affect some of you, and so this is the kind of big change. So in 2020, you can take penalty-free coronavirus-related withdrawal from your retirement account, such as 401k, your IRA, the 457 plan, up to $100,000 in aggregate in 2020. So what is considered as coronavirus-related distribution? The distribution must be made in 2020, as I mentioned, and it must be made to a person who is diagnosed with SARS-CoV-2 or COVID-19 by a test approved by Center for Disease Control and Prevention, or its distribution is made to the person's spouse, if the spouse or dependent was affected by COVID-19. In addition to that, you can also make that $100,000 penalty-free distribution if you are experience adverse financial consequences as a result of being self-quarantined, furloughed, or laid off, having work hour reduced due to the virus, being unable to work due to lack of childcare, the closing or reducing hour of a business owned or operated by individual due to such virus, or other factor as determined by Secretary of Treasury. So if you decide to take $100,000 out of your retirement account, then you have 3 years to recognize taxable income. So let's say you take $100,000, let's say you take out $90,000 in 2020 because you meet all the above, one of the above, then you can elect to include just $30,000 of taxable income on your 2020 return, the other $30,000 on your 2021 return, and the other $30,000 on your 2022 return. You can also elect to include the entire amount on the 2020 return. However, if you decide to spread your income over the 3-year period, so you only recognize $30,000 on your 2020 return, you cannot change your mind and say, I want to recognize the rest of the income, the $60,000 on your 2021 returns. And you can also pay back the loan within the 3 period, and you won't be considered income to you. So let's say you take out the $100,000 loan now, and then you go back to work and you say, well, I don't really need the money. You can pay it back, or you can hold on to the money and then wait till 2022 to pay it back. And that's considered considered a non-taxable distribution. You'll be a trustee to trustee direct rollover. The other change in the retirement account is that you can also borrow money from a qualified retirement plan. Before CARES Act, the limit is $50,000. You can only borrow $50,000 from a qualified plan. Now the limit increased to $100,000. If the qualified plan, like 401k plan, allow, you can borrow up to $100,000 from your 401k plan. And you also have 6 years instead of 5 years to pay back the loan to the qualified retirement plan.
So Bella, if for example, someone does take money out, they take it out originally as a loan, and then they figure, something happens and they can't pay it back, they find out the next year they can't pay it back, would they still be able to take advantage of that 3-year rule of, being able to either take the 3 years to pay back, or just to say, I'm just going to take it out as, as income and not be subject to that penalty if they're younger than 59 and a half?
Yes, but they have to they have to know they cannot pay it back in 2020. So that 3 years rule is only applied for distribution in 2020. So if they say they take the loan and then they know they're not going to pay it back, then they will recognize, if they decide to do a 3 years spread over, then they will recognize a third on their 2020 returns. Next, I'm going to go over another provision in the CARES Act is the employer pay student loans. And this also only apply in 2020. So in 2020, the employer can choose to make the repayment on the employee's student loans for during the period between March 27, which is the enactment date of the CARES Act, and before December 31st, 2020. So if the employer pay the student loan for their employee, the amount is excludable from the employee's gross income. But there's a $5,250 limit per year per employee. The reason for that dollar amount is the student loan repayment are treated as the employer educational assistance program under the Internal Revenue Code Section 127, which has this $5,250 limit per calendar year. This exclusion can be applied to payment made directly to the lender or to the employee on a qualified education loan. However, the employer cannot make the loan repayment for the employee family member. So the employee cannot say, well, I will pay your child student loan. That won't qualify. And since the employer is making the payment on the student loan, the employee won't be able to deduct the interest on the student loan on their personal returns.
And that payment is deductible for the employer?
Yes, correct. So that's deductible as employee benefit expenses. Next, I would like to go over the change in the required minimum distribution rule. And this also just applied to tax year 2020. In 2020, you are not required to take your required minimum distribution from your retirement account. This applied to taxpayer who reached 70 and a half in 2020 and who reached 70 and a half before December 31st, 2019, but have not took out their first requirement minimum distribution in 2019. In other words, if their first required minimum distribution in 2020, then this rule will apply. So another thing to think about is now, because today's market, everything is, the value is very low. So when you think about your retirement planning, now may be a good time to consider to convert your traditional IRA to a Roth IRA. Because with the lower value, then when you do the conversion, then the amount you have to pay the tax on will be low. Next, I would like to go over another change in the health saving account, the flexible spending account, and the health reimbursement arrangement rule. So it's the HSA, FSA, and HRA. So the CARES Act permanently, and this is not just for year 2020, the Act actually permanently restate that the over-the-counter product are eligible expenses for HSA, FSA, and HRA reimbursement. No prescription is required. In addition, this may affect a lot of female like us, is Menstrual care products are also considered eligible expenses now. So we can use our HSA, FSA, and HRA to purchase items such as 10-pound pads and menstrual sponges. And this changes effective January 1st, 2020.
Is it only good for this year though, or is that the change in the plans?
It's permanently, not just this year. Yeah. Good. Yeah, so you will apply next year and forever. give a woman a little incentive. The other change, and this only applied 2020 and 2021, 2 years. The CARES Act also temporarily allow high deductible health plan with the HSA to cover any telehealth or remote care expenses, even though the participant has not reached their deductible. And this applied to 2020 and 2021. So even you haven't reached your deductible, but if you use some telehealth services or have some remote care expenses, you can request a reimbursement from your HSA. The other big item in the CARES Act is the net operating loss business. So before the tax in December 2017, we have a big tax law change, the Tax Cut and Job Act. When they enact the Tax Cut and Job Act, they suspend the net operating loss carried back. So for all the losses incurred after January 1st, 2018, you can only carry forward, you cannot carry back. They also place an 80% taxable income limitation on your ability to utilize any loss that was generated after January 1st, 2018. But the CARES Act repealed the 80% limit, and in addition, it allowed any loss incurred in 2018, 2019, and 2020 to be carried back 5 years. So it actually create more work for accountants because now we are all busy trying to carry back the loss for our client and get in some additional cash for the cash flow. So you know, and the big thing is in 2020, many businesses are struggling and they may have a loss. So now they have the opportunity to carry back the loss to get some refund back. The other big change is this called assets business loss limitation. This also really came out of the Tax Cut and Job Act. Is that let's say you own a business and if you have more than 500,000 of loss in that year, you can only deduct up to 500,000 on your personal return. But now they retroactively delayed that excess business loss limitation until 2021, and also they repealed the limitation for 2018 and 2019. So this is another big opportunity for you to go back and amend your 2018 and 2019 if you already filed your 2019 return, to remove that limitation and get some refund from the IRS. Last, I would like to go over the change in the charitable contribution deduction, and this only applied to 2020. Year 2020, let's say if you don't take itemized deduction because your total, let's say you are married, file joint, your total itemized deduction is under less than $24,000, so you're just taking the standard deduction, then you are allowed to claim a $300 above the line deduction, which is a deduction before your adjusted gross income for the cash contribution you made in 2020. And on top of that, let's say if you do take itemized deduction and you make some cash contribution in 2020, before CARES Act, the deduction is limited to 60% of your adjusted gross income. Now the CARES Act increased the limit to 100% in 2020, and this is only applied to 2020, and it's 100% for individual. For we call a C corporation, the limit increased from 10% to 25%. That's the end of my presentation. Hope you find the information helpful. And again, hope you can use the information and to think about your 2020 and even your 2021, and then your tax situation going forward, and do some good planning to save some cash. And then hopefully you'll get through this crisis, and then we will, this will help you with your investment and tax planning.
Absolutely. So Bella, just to your point, you guys are going to be super busy, I think, for the next, oh my gosh, for the next at least year. And so this is going to be interesting. Are you going to think that you're going to have to be looking at amending a number of your clients, your customers' previous tax year returns too?
Yes, so we actually do what we call a data scan. We have all our customer tax return in our system. So we do a scan of all the return and find out who had a loss in 2018 and 2019,
Wow.
or if our late 19, and then we now we are pretty busy, like you said. So we try to reach out to the client and discuss the CARES Act with them and tell them about this cash refund opportunity. And then we are, our plan is to get all those amended return or refund claim done in the next 2 months. One of the challenge we have is that the IRS they don't their office is closed. So a lot of those amended return will need to be signed and filed on paper. They don't really have a physical person to process those returns, so that can delay the payments. But we also hear that they may open the office in next couple of weeks, so hopefully by the time they open, they can process those refund claims pretty quickly and get our client money back.
All right, keeping fingers crossed and
I know.
blessings. So thank you everyone for taking this time. As you can see, Bella's information is here, and as I mentioned, she is in our vetted network of professionals. We have a number of clients that are working with her, so you feel free to reach out to her. She's in the Long Beach location as well. So with that said, we look forward to sending out our gig tips next week. In the meantime, stay safe, secure, and sound and healthy. Care about you all. Bye.
Bye.